Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing MPLX's stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a large cap company, 42 billion market cap. They're trading at $42 a share, lucky 42, and they have 1 billion shares outstanding. MPLX is a master limited partnership formed by Marathon Petroleum Corp. Their ticker is MPC. And the way this company makes money is they own and operate midstream energy infrastructure and logistics assets. They also provide fuel distribution services. Their assets include a network of crude oil and refined product pipelines, also an inland marine business, light product terminals, refinery tanks, docks, loading racks, and crude and light product marine terminals. They also own crude oil and natural gas pipelines, NGL processing and fractionation facilities in key U.S. supply basins. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Free cash flow is really consistent, around $4.2 to $4.4 billion a year. And they pay a really high dividend, 8.14%, which cost them $3.5 billion of dividend payments, which they can cover since their free cash flow is about $1 billion more than that. Look at their margins. They converted 42% of their revenue into free cash flow in the trailing 12 months. Net income is the profit or loss on the income statement. It's revenue minus expenses. That's also really consistent. $4 billion in 22, 23, and the trailing 12 months. Revenue is the sales for the company, and that's gone up very little, from $9.5 billion to $10.5 billion. Revenue per share is $10.37. The way you calculate that, you take your revenue over your shares outstanding. Since their share price is 42 and their revenue per share is 10, that means their price of sales is about 4. We estimated 4 years of future free cash flows. We also estimated the terminal value, it's all cash flows, past year 4, that's $58 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $57 billion. We divide that by 1 billion shares. And we get a calculated stock price of $56. They're trading at $42, so they're trading at a 25% discount. It's a buy according to the model. There are 48 companies in the same industry as MPLX, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They only spend $1 billion in CapEx, a lot lower than the top 5 companies. Debt to equity ratio is 1.6, which is between the median and average. A really high dividend, 8.1%, higher than the median average. They generate $4.4 billion of free cash flow, which is double One Oak. They rank 6th in market cap. They're trading at 3 times book value, a really good PE, 10.5, better than the median average, also better than these top 5 companies, also better than 7 and 8. Price to free cash flow is a little below a 10, which is a little worse than the median. They're trading at 4 times revenue. We looked at that earlier when I showed you their stock price was about 4 times their revenue per share. They generate $10 billion of revenue, far behind number 1 ET, my favorite midstream stock, and they're still growing. Their 5-year annual revenue growth rate is 8%. If you put $10,000 into this company 10 years ago and reinvested the dividends back into them, you'd have $16,000 today. That's a 60% return, a 5% annual return. If you put $10,000 into this company in April 2020, you'd have $50,000 today because it was down to $2,500 and it went up 6x from that point. Here's the stock price of Brent Crude and a bunch of other midstream companies the past 5 years. So you can see they all move together. Brent Crude is a dark red line. MPLX is the gray line, up 32% in the past 2 years. Williams is better, the only company that's better, 41%. Some are negative. Let's take a look at their financials. This is the first quarter of 2024 versus the first quarter of 2023. We'll start with their income statement. Revenue $2.8 billion. And they break it down pretty well here. You have service revenue, $658 million, and then more service revenue, rental income, product sales, sales type lease revenue, and then they show their expenses, $1.6 billion of expenses. And they give a lot of breakdown on this as well. Cost of revenue, $370 million. Purchased products, when they actually buy the oil, $369 million. Depreciation, G&A. Operating income, $1.25 billion, up from $1.2 billion. Net income, $1 billion, up about $50 million from last year. Their EPS is 98 cents, up from 91 cents. And they've added shares. They added 7 million shares. It's now currently 1,008,000,000 shares. Actually, units. They don't have shares because they're an MLP. Let's take a look at the balance sheet. Current assets, $2.1 billion. Current liabilities, $3 billion. So current ratio well below 1. They may need to add some debt to get through the next 12 months. Current assets are assets that can be liquidated into cash within 12 months. It starts with the most liquid, cash, and then it gets less and less liquid. Property and equipment, not nearly as liquid as inventory. That's $19 billion. That's their biggest asset. They give a breakdown of the PP&E, the $19 billion. $9 billion is logistics and storage. The gross value minus depreciation is $9 billion. Then you have gathering and processing, $10.6 billion. $15 billion gross minus $4.2 billion depreciation. Total assets, $36 billion, same as last year. Total liabilities, $23 billion, same as last year. Their biggest liability is long-term debt, $19 billion of debt. They don't break out their debt. They just list a fixed-rate senior note for $21 billion. $1.6 billion is due within 1 year. So that's why you see $18.8 billion in the long-term section. That's due after 1 year. This is the long-term debt due within 1 year, $1.6 billion. This is due after 1 year. Assets minus liabilities equals equity, $13 billion of equity. They raised $9 billion from issuing common units. Marathon Petroleum injected $4 billion. Let's look at their statement of cash flows. The first section is operating cash flow, $1.3 billion. That's how much cash they generate from running their day-to-day business. Net income of $1 billion, that's their accounting profit. It's not actual cash. Operating cash flow converts net income into cash. The second section is investing cash flow. They spent $1 billion, $255 million of PP&E, $622 million from acquisitions. That $622 million was cash paid for Utica Midstream Company. They also invested in other companies, $119 million, but they did not consolidate those companies' financials onto theirs. So that's why they call them unconsolidated. Utica is consolidated. In the financing section, you can see how much they paid in dividends, $853 million. They also bought back $75 million of their own stock. So in their financing section, that a cash outflow of $958 million. Let's take a look at a company on Simply Wall Street. Its last price, $42 billion market cap, up 1% in the past week, up 22% in the past year. Let's see what they say about the company. MPLX owns and operates midstream energy infrastructure and logistics assets, primarily in the U.S. It has two segments, logistics and storage and gathering and processing. The company is involved in the gathering, processing, and transportation of natural gas, gathering, transportation, fractionation, storage, and marketing of natural gas liquids, gathering, storage, transportation, and distribution of crude oil and refined products, as well as other hydrocarbon-based products and renewables, as well as sale of residue gas and condensate. They were incorporated in 2012, headquartered in Findlay, Ohio. And they're a subsidiary of MPC, Marathon Petroleum Corp. Here's their historical stock price since 2012. It started out at $27. It reached its all-time high in 2015, right before the 2015 oil crash. Then in 2016, it came down to below 20. It didn't get that much higher over the next few years, taking a big dip from the April 2020 oil crash, which is right around the time of COVID. It fell to its all-time low of $10. But since then, the stock has done pretty well, breaking through 40 recently. Simply Wall Street is really bullish on this one. They're at $78 a share. They say it's 47% undervalued. 15 analysts priced this stock at $45. Their revenue forecast for 2024 is $12 billion. That's a forecast from 8 analysts. $12 billion in 25, also $12 billion in 26. So not much projected growth. Free cash flow is projected to grow from $4 billion this year to $5 billion in 2026. Their revenue was under $500 million in 2013, and look how much it's grown over the years, mainly through acquisition, almost $11 billion currently. This red line is their debt, the blue line is their equity. It's always been pretty close, but now their debt is getting a bit higher than their equity. And their cash is pretty low, only $385 million of cash. Their yield went from 2.3% in 2014 way up to 18% in February 2020. That's mainly because the stock price crashed, so the yield went up. The forecast is almost 10% by 2026. The CEO's salary went from $400,000 to $1.7 million. Total compensation $24 million. Tenure as CEO 7 years. 64% of their ownership is by public companies, 22% by institutions, and 14% by the general public. Their parent, Marathon, owns 64%, then Alps. And the ticker only trades in one place, the New York Stock Exchange. So let me know what you think. Give the video a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking the link in the description below. Thanks for watching.